Welcome back to Equity Mates, a podcast where we explore what's possible in the world of investing. We're here today with Andrew Brown to do bold predictions. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited. We always like to start the year the same way, and some people might laugh that we're starting the year in mid-February.
Yes. Got to take a holiday.
That's what we're doing. We always like to start the year with bold predictions, and we have made some of our own, and you can listen to that in the podcast feed from Monday. But now we're joined by Andrew Brown, our returning expert, to make some bold predictions for the year ahead. Andrew, thanks for joining us.
Absolutely. Thanks for the invite. Can I just stress to the audience, this is Bold Predictions 5.
Yes.
So a bit like Die Hard. There are 5 Die Hard films. Hopefully we get to number 6.
Hopefully. So we'll see how we go this year.
It's number 5. It's recorded on the 13th of February. And just to give you some context, S&P 500 is 5,022, up 6% on the year to date. The Nasdaq 17,883, that's the 100, that's up 6.3% year to date. As usual, the ASX 200 is 7614, and that's up blot year to date. And the 10-year bond rate in the US is 417. Okay,
Nice.
So not quite the year-end levels on a lot of those. That was 387 last year.
So we've got a lot to cover today.
We have.
We asked Andrew for a high-level view on some of the predictions. We're going to be covering the big stocks. We're going to be covering bonds. We're going to be covering scandals, media landscape, sport. So we've got a lot to get to, 15 in total. But before we get into it, 2 quick bits of housekeeping. First of all, a reminder that whilst we are licensed, we're not aware of your personal financial circumstances. Anything you hear on this podcast is for education and entertainment purposes only and is general advice. The second bit of housekeeping, the Equity Mates community survey is live. You can see the link in the show notes. If you have thoughts on what content you like, what content you don't like, and what we should be doing, what experts we should be speaking to, what stocks we should be analysing, let us know via the community survey. Now, with that said, Andrew, when you sent the 15 or the high-level look at the 15 bold predictions, number 1, you said very bold and secret. So we have no idea where you're starting today.
Okay.
So kick us off.
Okay, number 1. I think 2024 is going to be chaotic. Okay, and I think it's going to be really difficult in investment markets, which obviously the first 6 weeks suggest otherwise. And bold prediction number 1 is that on November the 6th, the president-elect will neither be Joe Biden nor Donald Trump.
Wow.
I don't think that's that bold.
You don't think that's that bold? I think most obviously Biden may pull out because of medical issues and just age, to be quite blunt. Yeah. And Trump could pull out for a number of reasons. He may be legislated out. He also may pull out for medical reasons. I mean, you have to go to sort of deep, dark places to understand what his medical conditions are, and they're certainly not a source for this podcast. And quite clearly, it's not beyond the realms of possibility that something may happen to him along the way. So, and then you say to me, well, okay, if it's neither of those, who's it going to be? And guess what my answer is? I have no idea. And neither does anyone else.
Yeah. Well, I put a bet maybe like 6 months ago on Gavin Newsom to be the president. So
it could be anybody.
Is he still in the race?
No, he was never in the race. Governor of California, but if Biden pulls out, he would be up there with Kamala as a front runner.
Absolutely. Yeah. So I think what that's going to mean is there's going to be an amount of chaos because they're not necessarily going to pull out on the same day or the same week. And I think quite clearly, if Trump were to win, last time when Trump won, everybody said, it would be bad for markets. And it was bad for markets for about 2 hours, because he ended up cutting the tax rate. But this time around, I think, there'll be no holes barred. He'll go completely bonkers. It will be highly protectionist, and that will be horrendous for markets over a period of time. So number 1 is neither of them will be there on the election's the 5th, so the president-elect will be the 6th, and it won't be any of them. And that's a real mystery to markets. Okay?
Wow.
Number 2.
Rusty. I was going to say something, but it's all right. Yeah. Keep going.
Number 2. As a consequence of that, despite the fact US inflation is going to be falling into the 2.5% range, I believe, US bond yields will not fall below 3% because the US is running a budget deficit of 6.3% of GDP. That's not going to come down under either candidate, even if I'm completely wrong about number one. The interest bill is 2.5%, and that's going up to 3%. So basically, I believe that US bonds are going to get a risk premium attached to them, even though they are, of course, the world's ultimate risk-free security from which everything else in the world is priced off. So I think there's going to be a bit of an extra risk premium attached to them. Don't forget last year, despite all the volatility in markets, you may have discovered this by now, but just in case you haven't, the US 10-year bond yield started last year at 3.87%. And it finished last year at 3.87% on the dot, on the money to the basis point. Did not move from December 31 to December 31. It went to 5 and obviously as low as 3.3 when the US banking system was under a bit of a creak in March, April. But I think this time around, bond yields are not going to come down as far as people think, even if short rates come down and Fed fund rates get cut. Just while we're on that, very quickly, don't forget we started this year with the most stupid thing, which was earnings growth of 11% and 6 Fed rate cuts expected in 8 meetings. One of the meetings was January, which we've already had, and nothing ever happens in January. So you were expecting 6 Fed rate cuts in 7 meetings. No, that's just how stupid the market got at the end of last year in relation to interest rates. Okay, not in relation to AI. Okay, but we can come on to AI if you wish.
Let's not get to AI yet. Let's start high level. And I think you mentioned in the intro that the S&P 500 is up 6% for the year, and a lot of that has been driven by some of the Magnificent Seven.
Correct.
I think Tesla's been like the worst performing stock of the S&P 500.
Yep.
So your third bold prediction is about the Magnificent Seven, the 7 big tech stocks in the US. What have you got?
I think the Magnificent Seven will fragment completely.
Okay.
Now, Tesla fragmenting already is not fragmentation because the other 6 are, in broad terms, moving together, bar one. Okay, and there's one of those not moving.
And for people who are unfamiliar, we're talking about Nvidia, Microsoft, Apple, Meta, which is Facebook, Alphabet, which is Google, like the big tech stocks.
Amazon, etc. Okay, Tesla was in there. That's fallen out. I will touch on Tesla later. Okay, but I think the fragmentation is going to happen for quite a few reasons. First of all, one of the stocks has no growth, and it trades on 23 times EV/EBITDA. It's got very, very strong cash flow, but it's barely grown for the last 3 years.
Hold on. Don't say it. Which one are you? No growth, strong cash flow. I mean, I'm thinking either Alphabet or Apple.
Yeah, I'm thinking Alphabet.
Oh, you're not right, and Ren is right. It's Apple.
Yeah, okay.
Okay, Alphabet's been growing. Okay, the issue for Apple is that basically it seems to be stuck between product cycles. Secondly, the services business, which was the real driver of it over the last few years, this kind of, profit growth in services is now down in single digits. Okay, so that's not a big boom growth. Now, Apple could come out with something whiz-bang new, and I was
going to say, you're not a fan of the glasses?
Vision Pro, come on.
Not a Vision Pro.
Anyway, we'll talk about this in another episode, but we will
bullish.
look back on this year and be like, game changing.
Yeah, okay.
Game changing.
That's the call. All right, that's the call. So if I'm wrong, I'm going to be wrong for exactly the reason you're right. Okay, but at this juncture, without new model smartphones, which are what drives it, that are game changers. Okay, and as you know, now and again, the smartphone becomes a game changer. There's something new about it that you've just got to buy it. I think that's the most likely one to actually fall away. The other likely one to fall away is Alphabet, because where Alphabet's at is, does AI really compromise their search business? Because you got the option now if you've got GPT-4, which I do. Okay, then that's your real alternative to search. And, does that take away from Google search? The numbers so far suggest not.
I'm a convert now. I'm a Gemini guy.
Yeah.
Yeah, big time. I think it...
Yeah, but the question's still the same. If Gemini cannibalizes Google search, even though it's the same company, the revenue isn't as good.
Yeah.
Yeah.
But I don't think it
But
will.
like-
I think it's like the use cases
Okay.
are quite distinct. I think it's broadening. I think that there. Yeah.
As I'm going to discuss later on in one particular sector, what I was predicting in one particular sector 5 or 6 years ago, and remember I'm a baby boomer, so I'm not Gen Z millennial, who, at the bleeding edge of this stuff. Is only just starting to happen. So some of these things take slower pace than you imagine.
Yeah, like the
So,
Vision Pro. You should
yeah.
remember
You think-
that.
Exactly.
You think Alphabet falls away more than Amazon?
Why is Amazon falling away?
I just feel like it's had
No.
its time.
It's number one in web services.
No.
Yeah,
It's-
outside
it's-
of web services
Yeah,
though.
no,
if that
no way
splits
it's
out,
had it. No way it's had its time. The big issue for people to confront is that 40% of Nvidia's business comes from Microsoft, Amazon, Meta, and Google. Okay, Microsoft, Meta, Amazon, Google in that order. Okay, and one of the interesting things I'm going to come to is what is the return on capital these companies are going to get out of all this spend? Because at some stage, investors are going to look at that and go, my God, you guys are spending so much money. Where's the incremental return on capital? And even Equity Mates followers, because I bet a year ago, none of them had ever heard of Constellation Software, and now they can all quote you it backwards. And they'd never heard of the Fair Isaac Corporation, and now they can quote you it backwards. Everybody's got wind of return on incremental capital, how great companies compound. So compounder was the word of 2023, really not the Magnificent Seven. Because if you look at what else went up strongly, it was those kind of stocks, irrespective of what valuation they traded on. And so you're starting to look at these companies. To give you an idea, Microsoft will spend $44 billion on CapEx this year.
wow.
Okay, its return on invested capital is 29%. So it's got to earn close on $13 billion on that incremental spend to make it worthwhile and non-dilutory. The same numbers for Google. It spends $32 billion a year, and its return on capital is about 31%, which when you consider it's carrying all this other bets stuff, which might one day when I'm a great-grandfather earn some money. So it needs to earn about $9 billion incrementally, and investors, I think, over the year are going to question that. And that's why the fragmentation will take place within the group. That Nvidia's ludicrously valued. I'll give you an example as to how much later on. But that, I think, is going to distinguish between the group. They're not going to move together for that reason. And I think that most of them, with a couple of exceptions, are extraordinarily well priced anyway, so that they may fragment just from the point of view everybody says can't justify it.
I would love to take the other side of that bet.
Yeah.
Yeah. I don't
That
think
is drive it.
I'm telling you
I-
why they'll fragment.
I don't think investors are going to all of a sudden wake up and think about these big tech stocks that differently. Like I think if we had a problem with some of these companies pissing away money on other bets, we would have had that problem for a long time. I don't think investor mindsets have changed that much.
Wow, they changed dramatically in April 2000. I'm telling you, we ain't that different to the first few months of 2000.
Oh, clip that.
You reckon? Yeah, click that. Yeah.
Absolutely.
Yeah, okay.
Eventually, I'll wake up. If my bond rate scenario is correct, if bond rates linger around in the fours and these things are trading on 30x times earnings and their return on invested capital starting to decline because they're going so headlong into AI, the question you also have to ask is, how do you incrementally monetize AI? Okay? Will I pay more for AI stuff? Are you going to extract more from me for an AI-driven product? You've got to ask, can they actually incrementally drive profitability from investing all this money in AI? And I think that's going to be the real question for investors in these stocks over the course of 2024. I accept the jury's out, okay? And I'm not taking a wholly negative viewpoint on that, by the way. I'm just saying that's the question you've got to ask.
Good question. All right. Well, number 4.
Yeah.
You've also said is another secret and relates to the prediction around Magnificent Segment.
Yeah, absolutely. Number 4 is Elon Musk will leave Tesla.
Yeah, that feels like it's
Yeah.
written.
I think it's becoming inevitable. I'll be blunt. I think the man needs help. You don't go on sort of things that are broadcast to a wide audience and tell people to go get effed. That's not acceptable. There's no new models in Tesla. The stuff that's new is all incremental. It's not core. He's been competed away by the Chinese quite aggressively. And the most bizarre thing is, for such a smart man, he doesn't seem to understand basic arithmetic. Which is if you cut prices, and that reduces your margins from 27% to 18%, it's very elemental arithmetic to say you need to sell 50% more cars, and that believe it or not, go through the accounts.
Why do you think he doesn't understand that?
He doesn't want to advertise for some reason. He's got some set against it. He wants to seemingly drive more and more volume, and that's reduced his operating margin from cars, not including energy and services, but it's reduced his operating margin from cars by about $4 billion a quarter. From its peak. Its peak was basically the December quarter 22, when he had a beautiful balance between volume and nice margin, and he's killed the margin, and he can't sell enough cars to make back up to the dollar gross margin, and that's impacting on the company. It's why the estimates are coming down. Don't forget the second-hand price of Teslas is collapsing, and BYD is just is eating his lunch in one of his biggest markets. So I think basically for some reason he's lost the innovation. Don't know why. Might be he's too busy. He's got too many other distractions.
Yeah, I think he's lost focus.
Yeah, he's totally lost focus. Yeah. And so I think he'll focus on some other things. And obviously, with the court award against him, there's pressure on the board quite clearly. The board are not that great, let's make it clear, because some of them are distracted as well, and all bar one are compromised. Lachlan Murdoch doesn't need this in his life, bluntly. And if I was him, I'd get out of it. So I think Tesla needs a change, and it needs to be a little bit more conventional, and I think Musk will leave in some shape or form.
Nice. All right, we are 4 predictions down. Yeah. We have 11 to go. Number 5.
Yeah.
This relates to what you said earlier about 2000. Yeah. Smells like 2000.
Yeah. Stinks like 2000. Can I urge everybody, and my thing about 2000 is 2000 was horrendous if you were stuck in crazy tech stocks, many of which were rubbish, okay? These are not the Apples and Amazons of today, okay? But what happened in 2000 is those kind of things fell to pieces. The NASDAQ fell to pieces. But if you were a value investor, you had a ball, because your stocks, which were trading on PEs of 6 and 7, all of a sudden started trading at PEs of 12. Yeah, and they did. You had a number of value stocks double. So value investors killed it. So my suggestion to you is the current market mania will subside, but equities are still an okay place to invest. It's probably just not in the indices. Okay. So the index can go down, the S&P 500 and certainly the NASDAQ and the ASX 200. But if you're smart about where you are, and we can talk sectorally, then you can still make a good return in 2024. It's just you're going to have to work a bit harder. Let me show you where to go. Morningstar have something called Style Box trademarked. Style Box. And what it is, it's basically a 9-square matrix. Across the top, it's got value, core, growth. Okay, so value stocks, core stocks, growth stocks. Down the side, it's got large, mid, small. And so, as you would imagine, it's, you could all draw the matrix, and you might not be able to put the exact numbers in, but you get the directions and quantums right. So large cap growth stocks in the past 12 months have returned 44% in the US, which is obviously, the big things. Small cap value stocks have returned minus 1.5%. So there's a 45+% gap between small cap value and large cap growth. And basically, large stocks, by and large, have outperformed small stocks, except in the growth area. So it's been growth. And so what my suggestion to you is, in the current market mania, is if you invest via ETFs rather than stock specifics, look for some value ETFs. One of the easiest things to look at what's going on is check the performance of the Dow Jones Industrial Average versus the S&P 500 versus the NASDAQ. And I think you might find the Dow Jones might outperform the other two this year.
Nice.
Because it's more value driven, it's more basic, it's got banks, it's got a drag called Boeing, but it's got kind of things like that in it. So just one thing to be aware of. In the past, I've come in here and said consensus earnings are too high, okay, and they're 245 points for the S&P 500, so it's on 20.5 times earnings, okay. Just to give you an idea of the 11% growth in consensus earnings for the current year, 6.5+% of that comes from the big six, okay, so not Tesla but the other six, okay, and I think they're going to continue to grow. I'm not going to come here and tell you they're not going to grow their profits and grow them probably quite strongly. It's just I think you're paying too much for that, except for one situation perhaps. And it means when you take those companies out with their big multiples of 30 odd, for Microsoft and Apple, not for Meta nor Google, if you take those out, the rest of the market's on about 16 times earnings. That's a tiny bit expensive, but it's not nuts. And there's plenty of scope to invest within that. So if you're smart and you want to go sectorally, like with value and a couple of other sectors I'm going to come to, with your ETF investing without having to go pick stocks, you could do quite well this year, I think. But you're going to have to do that, I think, rather than just have an S&P 500 ETF.
Yeah, I understand what you're saying. I'm going to challenge your 2000 characterization, because I think 2000 was similar to 2021, where there was a lot of crap that had been run up, and then all that fell away. Unprofitable, hyped stuff. Whereas what you're talking about here is undoubtedly high quality companies, but will they continue to grow? I'm going to say it smells like 1974, where the Nifty 50 there was a generation of investors that could buy the Nifty 50, the big 50 US stocks, blue chip, high quality, but they just got overbid.
1968's the better analogy on that.
Well, either way,
if you want it,
hold on.
John Brooks,
just
the go-go years.
Just so. There was a lot of quality companies that got overbought.
Oh, yeah, they did.
And then the question was, could they keep growing?
Yeah.
And I think that's the better analogy. For people who are worried about what you've just said, you're not saying that Microsoft and Amazon are the pets.com of the next generation.
No.
You're just saying that
I'm not even saying they're going to halve or anything like that. I'm just saying they are going to retrace. Okay, that doesn't mean to sell them. Okay.
Yeah.
Don't forget in 2000, things like News Corp, which were high quality businesses, got bid up to crazy prices, and those shares came back considerably, as did many other high quality companies. Don't forget, everybody, the great analogy from 2000 is Cisco. Cisco's still around, Cisco's still doing really, really well, and Cisco's still not at the price it was in 2000 because you were paying too much for it in 2000. That's my warning. So, and I'm trying to, as I said in prediction 3, trying to show you what might be the issue that investors focus on as the year goes on, that unhinges them slightly. Let's put it that way. So keep an eye on the style box from Morningstar, and keep an eye on the Dow Jones versus the others.
Love it. Well, Andrew, we're going to take a quick break, and on the other side, we're going to talk AI scandals, Aussie dollar, plus a lot more. We'll be right back. Welcome back to Equity Mates. We're here with Andrew Brown doing bold predictions for 2024. And Andrew, we've got 6, 7 and 8, number 6, 7 and 8, AI scandals, changing media landscape and sports. What have you got?
What do I got? Okay, number 6, I think there will be a major scandal in AI. It will relate effectively to copyright theft. Obviously, there'll be. We know about scandals already about using AI to create pornography, featuring well-known people. So that's not going to go away, but I think somehow or other it's got to get legislated against. So there'll be some major scandals. The main one you've had at the moment is the world's largest music owner, which is Universal Music Group, has turned off the music on TikTok. Okay, and basically TikTok were trying to rip off UMG, which if you're ripping off UMG, you're ripping off the artist. Because the one thing about UMG, Warner Music, Sony, and even Spotify, okay, is there's now been a recognition that the artists have been systematically underpaid for years and years and years, and that they can do different things to get more of the money for themselves, okay? Who owns Taylor Swift's rights to the Taylor version?
Taylor.
She does.
Taylor, thank you. She partners with UMG, okay, who help her immensely, but she owns the rights. And increasingly, when you get to that sort of thing, you're going to get to a situation where, to protect themselves and to protect the artists, because what UMG do for their artists is incredible. It's why they're a phenomenal company, and you should keep looking at them. But I think there'll be more and more scandals about AI, and it's going to really lead into the whole copywriting issue.
I mean, that's not really an AI scandal. That's just a...
Well, it is, because it's the use of the technology to basically subvert paying people who are supposed to be paid.
Well, it's just TikTok. They just want more money from TikTok.
Yeah, TikTok basically have shown the usual Chinese lack of respect for intellectual property. In this case, it's songs as opposed to product. But it's going to come to something.
I think you're a UMG shareholder. We should let's make that clear.
Through about 5 different routes.
Because I feel like there's a different interpretation of this dispute. But yeah.
I reckon we'll see the first major court case of some celebrity getting majorly
paid out.
Or what's the word?
Deep fake.
Yeah, like a deep
absolutely.
fake, or
it'll be deep fake celebrity. They will take
something really
damaging
damaging beyond the Taylor Swift nudes and those sorts of things. But
absolutely.
I think that's where it gets to.
Yeah. So
did you see the hackers that created a deep fake of a CFO logged into a meeting in Hong Kong and got this other guy, like a guy in the finance team, to transfer $26 million.
No way.
Yeah, because he thought the CFO was delivering this. You need to transfer this money.
Yeah.
Wow.
Yeah.
So it's.
I mean, as quickly as these things happen, there will be new controls.
There will be.
Yeah,
there will be. The
risk.
Yeah, it'll be like you can't just take the CFO's word on a video call. You need.
Exactly.
Need 2-factor authentication.
The risk is that the Googles and the Amazons and the Microsofts get legislated against. Google is the one that is obviously in the gun sights, which is why Google trades on a P of 21 and the others are broadly in the 30s. Meta's not. Meta's lower quality. Okay, and so it's a lower PE stock as well. So there you go. I think that's another thing that will just shake up the current mania.
For people who are interested in this, the court case to watch is the New York Times one.
Yeah.
That's going to be where a lot of this stuff first gets tested in court.
Absolutely.
All right, next up.
Number 7. I believe media ownership in Australia is going to be shaken up in 2024. The reason why is Channel 10 belongs to no one. It notionally belongs to Paramount. It's got a value, don't know what. Foxtel's declining at a rate of knots. The radio market is in flux. I urge you, if you don't believe me, to look at the Seven West Network interim results presentation, which has a 20-year chart of TV media revenue, not for them, but for the whole market. It peaked in 2010. Okay, and as we know, you guys don't own TVs. You own computers or Apple TVs, and if there's something you want to watch, the one program a year you want to watch on free-to-air television, then you just stream it through their MVODs. And basically, what you're looking at is you're looking at the gradual creep of the Netflixes, the Amazons, the Googles and others basically into what is effectively free-to-air media, okay, or very cheap-to-air media, let's call it, at $10 a month or $14 a month for all kinds of product. So that's going to start getting turned upside down. And don't be surprised if you see someone like a Netflix, a Google, or someone buy a free-to-air network. Well, because it's just widening out their scope. Yeah. They're buying production studios and they're buying a library. of various things. So these things may get undervalued, but I think the ownership, Channel 10 will not be owned by Paramount by the end of the year, that's for sure.
Yeah.
Okay, and don't be surprised if Channel 7's ownership changes. Dad wants to keep it because it's politically advantageous and he has influence, and son thinks it's a...
Yeah.
See you later.
When you say dad, you're saying
Dad is
Kerry
Kerry
Stokes, and
Stokes,
then his son.
Ryan's not intermediate.
Not your
So-
Ryan likes bricks and concrete, and damn right
Yeah.
too.
So, Andrew, one of my predictions, we did our own episode on Monday, and my prediction was we see a major transaction with at least one of the three free-to-air TV networks.
Absolutely
so
right. I think
great,
you're spot on.
great minds think alike.
They do.
I'd be surprised if a major US tech company bought an Australian free-to-air TV network, but
I would be as well, but
yeah.
it's just incremental small change,
Yeah.
so it might be of interest.
All right, next one is sport.
Yeah, next one relates to all this stuff gels together really well. Okay, what's killing free-to-air TV in Australia? Well, the killer for free-to-air TV in Australia is sports rights, because sports rights inflation's been huge. Okay, and they've driven it themselves until the last few years. But of course, they pay the wrong price for the wrong sport. Okay. There's only two sports in Australia worth paying for, nothing else.
Hold on, AFL and Rugby League.
Yeah, absolutely. There's nothing else worth paying for. Okay, and around the world, there's only in outside of North America, there's only one sport worth paying for, which is football. And in fact, there's only one league worth paying for.
Two now. Indian Premier League as
Indian
well.
Premier League. Sorry, my apologies. Correct.
Anyway.
Yeah, but in most of the rest of the world, there's only one sport worth paying for, which is football, and by and large, the English Premier League and the UEFA Champions League. Okay, so my suggestion to you is sport, because of the massive inflation of sports rights over the last few years. Okay, and I am a shareholder in Manchester United. And I've tendered my stock only because I'm going to get a very high price for part of it and I'll buy it back, is I believe another English Premier League team will be publicly listed by the end of the year.
Okay. Interesting.
Okay.
Any ideas on who?
I have some thoughts, but I just want to give you an idea why. When Manchester United, when the Glazers said we're reviewing the ownership and the structure and everything else, they had 170 viable contacts. They signed 26 non-disclosure agreements, 19 people entered the process, and there were 10 non-binding indicative offers at the early stage. And the source of that is the document they put out for the Ratcliffe tender of a quarter of your stock. It's the most brilliant 8 pages of reading on how investment banking works. It's fantastic. Okay, and you ended up with Ratcliffe, as the player. So I think sports are an investment proposition. They have been in America for a little while, but there's still only a handful of publicly listed teams. Well, I think one of the other EPL teams will float. If you asked me to say which one, I suspect it will be someone like Liverpool, okay, because they've got American owners, or it could potentially be Tottenham. Okay, simply because Tottenham have a massive asset which people undervalue, which is the stadium. The stadium is a £1.25 billion stadium. Okay, so you can buy Tottenham shares on the unlisted market, and I think they're quite undervalued relative to other stocks.
So let me put the counterpoint to you, which is that we're at the peak of the cycle in TV rights. And I listened to Mark Cuban speak about selling the Mavs, and he didn't explicitly say that he thinks we're at the peak, but he implied it pretty strongly. He thinks the economics of teams have to change, and he's now doing the whole like resort casino in Texas thing. But he was basically he was talking about how we've seen massive TV rights inflation, but those players that were bidding up the price are starting to really struggle, and those that are still there are now merging together, which we've seen in the States.
It's really interesting. US TV sports in the US, okay, it's a real mixture of national, but so much of it, because, the sports play so many games, basketball, baseball, and hockey, play 160 games a year-ish, okay? And so it's local, even local radio, let alone local TV. And so they're not sports rights where people are garnering a major advantage, okay? NFL, yes. English Premier League, yes. European Champions League, yes. You're looking at pan-continental, rights. And that's what makes the English Premier League so valuable. It's not people in England staying at home on a rainy Monday night, in Walsall. It's global. Mm-hmm. It's people in Thailand sat on a deck chair having another Singer beer. It's people in India not watching Indian Premier League, but watching English Premier League. It's people across the world. It's Americans. Okay, and that's what makes those things. That's what makes those things tick. The other aspect of America peaking out maybe is, of course, the whole concussion issue with NFL and everything else. But they have a new lease of life after this year's Super Bowl, and the ultimate fairy tale. Brilliant. Okay, but no, I don't disagree with him in some ways. It's interesting he's selling the Mavs because basketball is obviously the one that's got the big TV rights negotiation upcoming, which will shunt it up because it's underpriced at the moment.
So, Andrew, for the next three, we're going to come back to Australia.
Yeah.
Number 9 is around the Aussie dollar.
Yeah. The Aussie dollar, I think, will at one stage at least go to 75 cents against the US dollar. Part of that's driven, I think, by chaos in the US, and I think the US dollar's ascendancy perhaps starts to be challenged a little bit more this year for the reasons I've said, a risk premium.
Now, for context, as we record, it's at 65 cents, and last year it got down. It didn't get into the 50s.
It didn't get into the 50s, no. I think it might have touched 63 last year. It certainly was at 75 at various stages last year. I think it will certainly go to 75 during the year, and it will end the year much higher than it is right now. Yeah, okay. So December 31, and we'll have sevens in front of it, and don't be surprised if it's 75. Okay. My number 10 prediction is, what's driving that? I don't think the official Reserve Bank rate will get below 3% this year. It's currently 4.35. I don't believe it will go below 3. Okay, because I think inflation in Australia is way stickier than it is in the US. Okay, US inflation I easily see at 2 and change. 2.5, but Australian inflation, for a whole variety of reasons, services inflation, the whole immigration issue, the whole supply-demand issue, I don't think will be below 3%, and I do believe Michelle Bullock has the type of spine and intellect which her predecessor lacked.
I don't think it'll go below 4.
Whoa!
Yeah,
that's
anyway.
Yeah. So with that, then I assume no rate cuts in 2024.
If there are, they'll be very small. So it's 4.35 at the moment. It won't go below 3. So I'm giving myself a bit of leeway.
Yeah, sorry. So you're not saying
multiple
the
rate cuts.
Sorry. I thought you were saying the inflation rate.
The official
the cash rate.
The cash rate won't go below 3, which some people think it will.
Right. Oh, so you're saying multiple cuts this year?
Yeah.
No, there might be one cut towards the end of the year.
What, a full point?
No, but if it's 4.35
to 3 is a long. I'm giving myself a lot of leeway here to make sure.
So you're saying there might be one, but you don't.
There might be one. Sorry, it's not going to be very many.
Can I just put those two things together? So you're saying inflation is stickier, and you don't think it will get back into the target range. No. Yet there will be rate cuts.
There'll be a small rate cut. Yes.
But why wouldn't they stay the course until they get inflation back in the target range?
Political pressure.
Okay, but I thought Michelle Bullock had a spine.
She does, but she has to have a really, really strong one. The interesting thing, my prediction number 11, is that the CPI stays at least 50 basis points or 0.5% greater than the inflation rate in the US. At the moment, US is 3.4, we're 4.1.
Yeah.
And I don't see any way that we're going to be down in the 2s. Okay. Yeah. And US, I'm telling you, I think we're going to be down in the 2s, and that's what's going to partly drive the Aussie dollar. Okay. And there are some other things I think that'll drive it, which I'm going to come to. Okay. So I think the Aussie will go up. So it could get quite interesting, but all those things don't necessarily bode that well for the Australian investment environment at the big end.
So just to wrap those up, the Australian macro predictions are the Aussie dollar will get to above 75 US cents.
Correct.
The official cash rate will be cut, but it won't go below 3.25%.
Yep.
And inflation will stay above the US and won't get in the target band.
Won't get into the target band.
Nice. So then that leads to 12, 13, and 14, which you've wrapped up as sector-specific ideas.
Absolutely. Number 12, Australian small caps will outperform big caps. Okay, so if you want to look at it on an index, the XSO, which is the small ords, so it's got the resource stocks in too, will outperform the XJO, which is the ASX 200.
Nice.
Okay.
Easy.
The reason why is they're too cheap in what might be a difficult economic environment. That's why people say, oh no, it won't work because the economy might be tough. Yes, it might be tough, but they're too cheap. They're already being, they're already being priced for destruction. There'll be lots of corporate activity because foreign companies will come and pick these things off where they're relevant. So I think some of the smaller resource companies will do very well because they've been smashed, already. So XSO will outperform XJO. So smalls will beat large. I think Morningstar do have a style box for Australia, but I couldn't find it that easily, and it may not be as good as the US one.
Fair.
Sorry, Morningstar. Number 13. I've come with this most years, but this year I'm more convinced than ever. And I was right last year, but not the prior year. Okay. Gold stocks will do really well from here. The world's largest gold miner is Newmont. They bought Newcrest last year. Newmont stock is down 40% in a year. It's down 20% in 6 weeks since the start of this year, from the start of the year to today, 13 Feb. Okay? And the gold price obviously has been rather quiet. Okay? If you don't like buying individual mines or individual stocks because you think the management are no good, then just buy something like GDX, which is the VanEck Vectors Gold Miners Fund, because you basically get the biggest gold miners in the world. And you can buy selected Aussies, even if the Aussie dollar goes up. Remember, the Aussie dollar gold price is like 3,000, and still some of them conspire to mess it up. But, because they don't get their production right. And costs have been going up for Aussies, don't forget. So I think a selection of gold stocks will do really well from where we are here now. So the best basket's GDX. If you're a bit more aggressive, GDXJ, which is the juniors version of that, so slightly more speculative. But I certainly think buying stuff. I do think Newmont's really cheap, which is, as I say, the world's largest gold miner, and some of the North Americans are really cheap. But perhaps the best way is through one of those ETFs.
Nice. And then number 14, Andrew, was around oil.
Yeah. Guess what? I'll be buying oil stocks too. Okay.
Right.
Why? Hey, the oil price has been a lot less volatile of late because the major oil producers are, they are definitely, they're definitely manipulating supply and demand to make it less volatile. With the oil price at Brent $80 a barrel, roughly as we speak, there's no major oil company in the world not making a ton of money at $80 a barrel. And so you've got to have a really bearish view on oil, which I do not. And if we're going to have a little bit of chaos around the world, and if we're going to have a bit of chaos in US politics, we might have a little bit of chaos in oil. And maybe that'll be dampened down because, to be blunt, the Saudis don't want chaos in oil really, even though they benefit when it's $100 a barrel for a brief period of time. But most of the major oil stocks in the US are on PEs of 11 to 12 at these kind of levels of the oil price. They're exhibiting far more capital restraint than they've ever exhibited in the past. And you're seeing that. Just follow Occidental, which is obviously the stock that Warren Buffett's been buying because he thinks it's going to disappear, so he's going to buy every share of it. Their capital management, in the last 3-4 years has been absolutely outstanding. It's been really, really strong. So, and to be fair, it's been much the same for many of the other US oil majors. And when they're on sort of 10 to 12 times PE at an oil price which looks fairly stable, I think that looks pretty interesting. And today's little trick fact, NVIDIA has a market cap of $1.75 trillion US dollars. It makes $19 billion of operating profit. the entire S&P energy sector, which includes obviously all the massive major oil companies, makes $147 billion a year of operating profit, and it has an equity market value of less than $1.6 trillion. So NVIDIA is capped greater than the entire US energy sector.
Wow.
So of the oil stocks, you said you were buying them at the moment. Is there one or two names that are at the top of your list?
I'm quite happy to buy Occidental because I'm buying it at a lower price than Buffett's been buying it at, and I like their capital management. But again, you can buy ETFs in this.
Yep.
If you don't fancy my stock picking or
What
whatever.
about the Aussies, Santos and Woodside?
Well, I think Santos gets really interesting now that the merger's off. So I think they're quite fascinating. I think there's a lot of potential spin outs from Santos, and I think the pressure's going to be on Santos now to actually do something.
Yeah.
Now, don't forget, it wasn't their fault the merger failed. Let's make that clear. It wasn't the Santos board saying we don't want to do it. Okay, there was a mutual walk away. Okay, so the pressure is going to be on Santos, and I think that's quite fascinating and quite interesting.
Now, speaking of fascinating, we've got to the final prediction, which when you sent them through was just 5 question marks next to each other. So, final prediction for 2024, Andrew. What have you got
The
for us?
final prediction for 2024 in a chaotic world, okay, of politics, of investment. There's one thing I think that's going to return to normal, that you can rest assured is going to happen, and you can rest comfortable that the world really is in its rightful place after all.
Aussie house prices up 20%.
It's that the Roosters will win
I
the
knew it was going to
NRL
be
again.
related, yeah. The Roosters win NRL.
Aren't you guys losing all your players? Like
No,
Joey
we-
Manu's going to rugby.
That's in
union
2025.
And
So we
are
have
you
one
losing someone
last
else?
shake.
And, okay.
No, we have, mate. The salary sombrero is alive and kicking. I can assure you. So yeah, there you go,
Okay.
guys. I think it's gonna be a hard year for you guys as investors. Okay, it's not going to be easy. You're going to have to do a bit more work, I think, than last year. But I think what's clearly coming through from my slightly ebullient mood is the fact that I think if you do that work, you will get rewarded. Okay, because there are some really cheap things underneath the very expensive looking AI fads. There are some really, really cheap stocks. I can tell you the Dynasty Trust I run is highly idiosyncratic stocks in it, and they're starting to get recognised. I think it's fair to say, and so it's not just what's in my little fund, but I think around the markets, just be a little bit more idiosyncratic and think outside the box a little bit more this year.
Nice. Well, that's a good way to end it, I think.
Yeah.
It is.
Let's keep looking outside the box throughout this year on this podcast. But for now, Andrew, until next time, thanks for joining us.
Oh, my absolute pleasure.